Hi, Raz. So we've seen a long period where we had negative correlation between stocks and bonds, albeit not always in the past. What's your prognosis about which environment we're heading into and what might cause that?
Well, I think it depends. We just spoke about timeframes here. So, yes, stocks and bonds negatively correlated the last 1 or 2 decades. But actually, if you look at it through periods of sort of like the 80s, the 70s, the 60s, we had quite static and stable positive correlation between stocks and bonds. And so the question is really what's actually different between structurally where we are now versus what has led to these correlations being negative. And so the biggest change to markets is really the return of inflation, and not so much inflation per se, but really untethered equilibrium of inflation. So where's it going to be? And so when you have an environment where we have an expectation of the risk of inflation being significant, stocks and bonds suddenly behave a lot more similarly. And so really a lot of portfolios, a lot of people that have been building portfolios in the 90s and 2000s have utilized almost this magic diversification, which you cannot rely on necessarily. So I think for us, when we look at our strategies, we don't try to bake in any assumption about correlation being negative or positive. Rather, we react to whatever the environment is, and at the moment with inflation being significantly unanchored, we're seeing less diversification between stocks and bonds going forward.
So on that topic, how do you think about diversifiers as a strategy overall? What would you guide investors to think about?
I think that's one of those very ill-defined spaces. So ultimately what we know is what people really tend to hold. So they hold a lot of equity beta in their portfolios. Whether you get that beta through listed assets or through unlisted assets, ultimately our portfolios from all the way down from high net worth to superannuation schemes, they need to participate in global growth. And so the question then is, what is a diversifier or a risk mitigation or a differentiated return stream to that main core risk that's in their portfolios? So if you sort of look at that framework, I think it's useful to think about maybe 2 different avenues. You have strategies that are either liquid or illiquid. So that's really a function of investment horizon and appetite for risk. And then specifically at Aspect, we trade within the liquid space. You can sort of slice the world into 2 other avenues. One is convergent strategies or divergent strategies. A convergent one being a strategy like value or an arbitrage where there is a concept of a mispricing. And so strategies are there to capture that and renormalize the markets. By contrast, divergent strategies like macro or trend are there to capture the flux, the change in markets as they go from one equilibrium to another. And so when you're building a portfolio, you need to make sure you have enough of each of these styles to be able to have a portfolio that over the full cycle has return streams that appear during periods of stability, like convergent strategies, or during periods of change, like trend and macro, as we're seeing right now.
So let's dig a little deeper into that trend following. How do you think an investor should think of trend following within diversifying strategies?
So trend following is a very reliable strategy that is able to navigate unseen macro events. So trend is basically a feature of markets that's really a function of aggregate investor behavior. So at times, markets are driven by fundamentals. At other times, they're driven by fear and greed. Trend is there not to judge what's driving the market, but really to capture whatever occurs. And so when you have periods of instability across the macro landscape, so we've had, there's lots of things we can point to right now, whether it's the renormalization of interest rates, whether it's the return of inflation, whether it is the geopolitical risk going from one polar world to a multipolar world. We've got the geopolitical risks of a hot war in Europe. You've got ships not going through the Red Sea at the moment. All these are destabilizing forces in the macro landscape. That, if you extrapolate, is a repricing of asset classes. It leads to a repricing of geographies. And trend is the natural strategy which captures those big, broad moves. And so the way people should think about trend is that it has correlations, negligible correlations to stocks, bonds, commodities. We tend to generate the majority of our returns during these periods of heightened market vol or big transition phases. So a portfolio that has got trend in it alongside stocks and bonds has a better risk-adjusted return than one that actually has only the traditional assets.
And in terms of this period of uncertainty, how does trend capture the whole price discovery process and seemingly quite rapid changes in attitude?
So effectively, the strategy is, it's heavily research driven. It's quantitative in nature. What we try to do is we try to build models that utilize all the information that we have at hand. So price information is useful, sentiment, term structure information. All these bits of data gives us a sense of which markets are moving and also how strong are the trends in those markets. It allows us to measure risks across the different regions and asset classes. And the strategy itself is really designed to deploy risk regardless of direction across the full spectrum of capital markets. And so if you think about a risk shock in one major asset class, so think of bonds 2022, think of stocks in 2008, think of commodities in 2014. There's a big exogenous shock to an asset class. That tends to propagate through the system over months and years as the world sort of maps itself the way sort of it adapts to that change. Trend following is designed to capture that dispersion. And so at the moment we are seeing the best opportunities in two asset classes that are not stocks and bonds, but actually are asset classes that have reacted to what's happened to stocks and bonds. So for example, currencies is the one asset class that is now rich with opportunity given the expectation of interest rates being so varied across the globe. And then secondly, unrelated to financial assets, we're in an El Nino period. Across the globe, whoever listens to this will probably agree that I've had unseasonable weather. That tends to actually shift a lot of the supply-demand conditions for many agricultural commodities. So that's been another rich area of opportunity for us to capture trends wherever and whenever they emerge. And that's kind of the cycle is to be unfitted, to be reactive, risk managed, and keep sort of harvesting and looking for those new trends as and when the capital markets offer them up.
So to close out, what do you think is potentially the biggest issue that you think investors should focus on in the coming, let's say, 12, 18 months?
I think there's a lot of complacency in markets about how sort of the inflation shock has actually gone behind us. My experience, if you look at sort of history, is important. The sort of inflation tends to go up like a rocket and then come down like a feather. We've seen a massive relief rally at the end of last year in stocks and bonds on the expectation that we're now done with the high interest rates, and yet the economy across the globe tends to be sort of keeps throwing up surprises. So I think the biggest risk is that markets as a whole are a little bit complacent on the potential that we are sitting in a higher for longer, more sort of higher inflation, higher rates, slower growth, more geopolitical risk than actually is priced in. If you're looking at the VIX or at any of these risk sentiment points, it's just not in there. However, you speak to people on the ground, everyone's nervous, and so there's this big disconnect between perception and what's priced in, And that to us, one of those camps is wrong. And so that adjustment will lead to some volatility, and we expect that to be constructive to our strategies.
Well, it's terrific to get insights from people like yourself across all asset classes. So thank you, Raz.
Absolutely, and it's been a pleasure. Thank you.